Okay. All right. So I want to welcome again Dan Valentine today to our webinar. Dan, thank you so much for being here and joining me today. I'm Kendi with KJC Insurance, and we have Dan Valentine with LifeBrokers Life Insurance. Dan, tell me, what are we going to talk about today?
Well, you know what? I've been getting a lot of, we can talk about anything, but I've been getting a lot of calls and a lot of emails from our agents as they're working with business owners or key executives and all, and they're asking what type of plans, what can they do for these higher compensated individuals that may be working for a company, or what can they do if they're a business owner and maybe they don't have any way they have ways, but maybe they don't know of any, or they don't have a current plan set up, ways they can put money away. And it's funny how oftentimes, you people say, "Oh, you're self-employed. You work for yourself. You get all these great perks and all." Well, the people that are actually doing that know it's not all roses all the time. But
Yeah.
sometimes, if you work for a big company, they might offer like a 401k plan or some kind of savings plan. And individual business owners, a lot of times, especially if it's a smaller company, don't have access to that, or it's not cost effective for them to try to open up one of those plans when it's just a few employees there. So I've
Hmm.
been getting a lot of different calls on that, and I thought maybe we could just chat about qualified versus non-qualified and how the different plans can work together and how they really work together to enhance the overall product and giving a lot more options than if you just had one or the other.
Okay. Well, I'm super excited to have this conversation, especially
Sure.
because, I'm self-employed and being a small business owner, I don't have the option to open up a 401k. I
Hmm.
have been placing money into SEP and a Roth, to put
Hmm.
some money away, but I'm
Hmm.
excited to learn more about another option that would be good
Sure.
for someone like me. So you did mention that there's qualified and non-qualified plans. So I'm
Hmm.
curious to know what specifically are those? What's a qualified plan? What's a non-qualified plan?
Okay. Let's start there. Before we go any further though, I want to take a step backwards, and I just want to let your audience know that this is just an overview we're showing to you, and there is such a thing as a single person 401k. So without beating us up, we're just going to give you some general information here and go from there. So and hopefully we're going to try to be as accurate as we can here. So qualified plans are plans that you might think of if you're doing an IRA, individual retirement plan. If you're at work and they have a 401k type plan or some type of profit sharing plan, defined benefit plan. Um, I would think that 401ks are probably as common or the most well known, I think, out of those. Hey, does your employer offer any type of benefits?
Hmm.
And usually at that point, people will say, yeah, we have health insurance, or a lot of people say we have dental. You've probably heard
Yeah.
these same conversations. Yeah, I got dental insurance and health insurance. And do you have a savings plan at work? And some of them don't even know exactly what it is. They may not be contributing to it, but a qualified plan would be one that um, I think a good way to get to the chase on that would maybe say, hey, do you get a deduction when you do your for your 401k? And if you're able to deduct it off your taxes, and then it's probably going to be a qualified plan
Okay.
versus a non-qualified. Qualified plans are very different. They have different rules, different regulations. They have limits on how much you can put into them.
Mm.
They have when you get older, 71, 72 and a half. They require what's called an RMD, or a required minimum distribution. The government says, "Hey, I've allowed you all these years to deduct this money and not pay taxes on it, and now it's time we want you to start. We've allowed you to save this money, helped you to save this money," is how they word it, and now we'd like you to be able to start taking that money out. And as you take the money out, then you would pay taxes on that. And and so there's nothing wrong with that. On the business side, the business owner side that might provide that plan for you, he has a fee for being able to do that. He has to file certain forms with the government. It has to be all compliant. It's non-discriminatory. You have to do certain things for him that matches or is in some proportion what it has for what the employees are doing. There's a percentage. There's also safe harbor plans. We're not going to go into all the different kinds of plans. But my point I'm getting at is it's a great benefit. Your employer that does a qualified plan is there's a cost for doing that. And that's why I mentioned at the beginning, a lot of employers, small employers, meaning fewer employees, say, hey, it's not worth the cost of doing that. Maybe we'll do something else. And other employers say, hey, I don't care what it costs, we're doing it. So again, it's up to the individual. We're not trying to make a point here, which is right or which is wrong.
Mhm.
A oh, and then I wanted to talk about a non-qualified plan. So
Mhm.
non-qualified plans are plans that don't have those requirements with the government at all. You can discriminate with those types of
Okay.
with a non-qualified plan. In other words, you could put one on if you and I were working together, you are working for a business owner, you could have one on you and we could have one on me, or they could be different amounts. Um, or the employer might say, "Hey, I want Kendi to have this plan, and Dan, I'm sorry, I don't want you to have it." And it's just how it is, and um, and that's okay. And there's nothing wrong with that. You're allowed to do that. Um, so the there's advantages to having both. And one thing, if you're in a situation where qualified plans typically have a match, or they could have a match,
Uh-huh.
where you'll hear people say, I get a 3% match, or I get a 5% match, or maybe it's more than that. But that's free money.
Yeah.
So if you're able to put money away in a qualified plan and there's a match there, I would suggest to most people, and of course, everyone's situation is different, but to the most people out there that are in their working ages, just to do that, to participate in a qualified plan, I think it's a great opportunity. So, in your world, or what we wanted to try to kind of talk about today, is business owners that maybe have a qualified plan or access to a qualified plan, and they're key men, women
Hmm.
that are working for them, and they're able to contribute into these plans, and they're getting matches, and they're all saying, this is great. But oftentimes you'll have a business owner or a key employee. We're just going to refer to them as key employee, an upper income employee that's working for this company that's able to contribute into that plan. It's available to them. Oftentimes they might max out the amounts that you're allowed to put into it. There's a limit. IRS has a limit set that you can only put so much in it into that plan. And and then I already mentioned that you uh, have to start taking money out at
Hmm.
70 and a half. The um, Another thing with that too is if you need to take money out of that type of a plan before you're uh, 59 and a half, you would have to, there could be a penalty. There could be a penalty for, usually it's a 10% penalty
Mm.
to take your money. And then what money you take out of that too, you're going to have to pay taxes on that because you're starting to take your income distribution sooner.
Hmm.
So those are some pros and some cons of that. And when you integrate, or if you're able to get a non-qualified in addition to your qualified plan,
Mm.
it kind of can fill the little gaps. I
Okay.
know I don't want to get on another subject, but I know with Medicare, you'll hear people say, hey, and then you have part A and part B because that
Right.
helps fill in those gaps. Maybe if you thought
Right.
of it that way. And for those that aren't familiar with those products, then I'll find another analogy here as we go forward. But it basically um, fills in some of those gaps. So let's talk qualified or non-qualified plans just a little bit. So
Okay.
life insurance, cash value life insurance is a form of a non-qualified plan.
Mm.
Business owners can can purchase these plans on, let's say they purchase them on for a key employee, or they just
Mhm.
say this group of these four employees I want to do this benefit for, but I'm not going to do it for anyone else.
Mhm.
There's no ERISA reporting to the Department of Labor. There are no regulations because it's a non-qualified plan, and
Right.
they can discriminate. And these plans, if you're using the form of permanent life insurance, which I know you're a big fan of, I am too,
Mhm.
to be able to fit some of these needs. If you're using life insurance, there's also that death benefit
Mhm.
that can be, depending on how the plan is structured, it can pay to the business owner at a death, and they can use that. That would be the form of a key man type insurance policy, and that can be used um, to uh, get through the gap while that employee's gone and not able to
Mhm.
be there. It can help also create cash and money to pay the surviving spouse if that document is in place. Um, it can be used to market and recruit and have bonus money, maybe to hire somebody to come
Mhm.
in and make that replacement. So the life insurance, there's nothing tricky about it. It's the vehicle that provides the cash to
Mhm.
be able to do one of those different types of things. Now, in addition to that, that's a benefit that might be to the owner. Let's go back now and talk to the employee or the highly compensated or the either the business owner doing this personally for themselves or the highly compensated key man. To them, the advantage is that if they're contributing into this policy at the beginning, they're putting in, it doesn't matter the number, $100 a month they're putting into this plan, and there's typically not a match. Let's discuss a plan where there isn't a match because there
Uh-huh.
are different ways it could be structured, and we're just going to get to the concept. So I don't want to confuse jumping back and forth between the different policies. So in this case, it's a life insurance policy, and the employee is contributing into it, and that employee can access when there's cash available. They can
Mhm.
access that income tax free, penalty free.
Mhm.
They could take it out, the money out in the form of a loan, and then repay that loan. Um, they don't have a RMD at 59 and a half or at 70 and a half, I'm sorry, where they have to start taking the money out with an RMD that we talked about with the qualified plan. And there's all kinds of examples. So let me just give you one. If you are in a qualified plan and you start taking money out, you're 70 and a half and you have to start taking uh, your required minimum interest. Here, I'm changing directions just a little. This might be even better. Let's
Okay.
say that you're retiring and you want to take money. You don't want to start taking Social Security yet
Okay.
because you're thinking, hey, if I wait longer, my Social Security will be higher. There's like a
Yeah.
window of a few years, 4 or 5 years in there. And so you could say, hey, I have a lot of cash value in this policy. I'm going to start taking money out of that first before and then delay my Social Security. That's one option. You're able to do that. Maybe you decide that you're retiring and you say, hey, you know what? My investments, it's not a good time to be taking money out of my retirement plans, my
Mhm.
qualified plans or whatever. So it can buy you that window
Mm.
of saying, hey, I'm going to start pulling from my life insurance first
Mhm.
until things get a little bit better. Now, granted, none of us know what's going to happen in the future, but it's nice to have options
Right.
depending on what happens. And I
Yeah.
think one of the major things with a non-qualified, if we're talking about life insurance, again, is that unlike a qualified plan, if you've got your 401k and you start putting in $100 a month, the dollar amount really is irrelevant here. But if you start putting money away into your qualified plan on a monthly basis, it takes years to
Mhm.
accumulate. It's ultimately a great thing, and it's still a great thing to do. I'm not
Mhm.
talking bad about it, but it takes years to accumulate to get up to 100,000 or 200,000.
Mhm.
With life insurance, day one, you open that plan up. And while you're making your contribution, whatever that amount is, or your
Mhm.
premium, it's accumulating cash value and death benefit.
Mm,
So if it's one day in, 1 year, 10 years, whenever you're vulnerable
mm,
to that somebody's counting on your income, somebody's
mhm.
counting on you being there, your children, your wife, relatives, special needs child, whatever that is, you've got that immediate cash value in the form of a death benefit
Okay.
right off the front.
Mm.
So ask me a couple of questions if you got there. I've been rambling
Yeah, I
here, but I
do.
think you
No,
have
you're
some questions.
I do. So correct me if I'm wrong with this, because you did mention, that the life insurance policy could kind of serve as that little bit of a gap between the time that a person would want to start taking out their retirement and just to
Hmm.
get them to that point so that they had a few more years before they start pulling. Now, if they started pulling money from the life insurance policy, um, would it not come out tax-free? Because you didn't touch on that, and I think that that's an
Hmm.
important message to get out. That is it not? Am I not? Am I correct? That's what I should say. Am I correct in stating that that money would be considered tax-free if taken as a loan?
Okay. Do you want to be correct or incorrect? Because
I
you're
want to
both.
be correct.
Okay. So you're both. It
Okay.
it depends on how you take the money out.
Okay.
So you can take withdrawals or you can take loans. And
Okay.
it's one of the few vehicles out there that's fantastic. Not only does the money grow tax favorable, or
Mm-hmm.
some people call it income tax free, but it also allows you the ability to take that money out. If you take it in the form of a loan, then you
Mm-hmm.
can take it. It's a loan that's going to be paid back typically out of the death benefit,
Mm.
or a lot of people pay the loan back. Um, so if you do it that way, it's income tax free. There's no
Mm.
reporting by the insurance company, and you don't get a 1099. You don't have to report it because it's a loan. If
Okay.
you took withdrawals out, then that's a different story. However, you
Mm.
have something that's called a cost basis, and the cost basis is basically just the premium that you've already paid
Mm.
into the policy. So if over those years you've paid in $50,000, if you take withdrawals out, the first $50,000 coming out of that is income tax free because you've already paid
Okay.
taxes on that. So it's
Okay.
just on the growth
Okay.
that you would pay this.
Okay, so and that causes a question to come to my mind.
Hmm.
If someone takes it out as a withdrawal,
Hmm.
is that a situation then that would not be repaid when they passed away?
Withdrawal would not need to be paid back out of the death benefit, but there would be a
Okay,
loan on it. So, or there, I'm sorry, there wouldn't necessarily be. No, I'm telling you wrong. There wouldn't be a loan on it. You're taking the money out just as in a withdrawal, so it
okay,
lowers the cash value. You have
got
to
it.
watch. Sometimes if you lower the cash value, it might lower the death benefit. So you just have to watch and make sure. But that's what you're here for, to help.
Hmm.
But your ultimate answer is no, there wouldn't be it wouldn't affect the debt. It wouldn't affect having a loan on it at all.
Okay. Now, when would someone choose a qualified over a non-qualified plan?
Well, I think it's an individual decision, but I think again, if somebody's work offers them that, then
Hmm.
I think it is a great way to, um, if it, especially if there's a match, then that employee could say, "Yeah,
Yeah.
let's do this. It's free money. Let's do it." But but there are some missing um, needs that need to
Mm.
be plugged, and that's where it fills in with the non-qualified or the life insurance. On the flip side to that, a lot of business owners, as you and I were talking about, I'm a small business owner myself.
Mhm.
It may be a great way. You only have so much money, let's say, to save for the majority of us. You
Yeah.
can't just say, "Hey, I'm going to save $100,000 a week." It's kind of, kind of,
That'd be amazing.
it'd be great. It'd be great. So we only have so much money. We have bills and everyone. We're just normal people like everyone that's watching this video. Hopefully, there's a lot of people watching it.
Mhm.
Um, and so I just the I'm losing my train of thought here. That's when you might say, "Hey, I've only got so much money here to invest, and I
Mhm.
need life insurance also." And I like the tax deferred. Being a business owner, I like the idea of saying, hey, 10 years into this, 15 years, oh, I needed some cash.
Mm-hmm.
I don't have to go to a bank and ask for it. I can get a loan
Mm-hmm.
and I can say, hey, I'm going to pay that back next month. I'll start paying it back. And all of a sudden next month it doesn't look good. And you say, hey, I'm going to have to defer my payments for 3 months. Though
Mm-hmm.
you set your own terms. It's
Mm-hmm.
your money. It's yours. There's a lot of people that a lot of business owners that I myself who had some old policies that I had had for years and years. And when I started my insurance practice, actually,
Yeah.
I used that money. I had about $60,000 in those, and it was fantastic. And
Mm.
I didn't pay it back for years, and then I was able to pay it back. But it got me started. I was able to
Yeah.
have that money that I couldn't have done it, and I really needed it. So
Yeah.
there's good with both. But I think it's something that somebody should take the time to call a professional like yourself and say, "Hey, tell me more about this non-qualified that guy was talking about on the video, and tell me what you think. Why should I look at this?"
Okay. Can you walk us through a couple of examples of who would be a good candidate for a non-qualified plan? Like, give us a couple of examples of like business owners.
Okay.
Does that make
Okay.
sense, what I'm asking?
Absolutely, absolutely. So we're not talking necessarily about somebody who's buying term insurance here. Term
Mm-hmm.
insurance would be, it's not really, but it would be considered if you had to categorize it, you could say it's non-qualified because it is non-qualified. But that's not really how we would look at term insurance. So if we're looking at permanent insurance, you could have somebody that's young, that's aggressively says, "Hey, I just want to save some money, and
Mm.
I don't have a qualified plan at work." Maybe it could be any kind of employee out there that says, "Hey, I just want to put some money away." And yes, I do have a need for life insurance. Those are the keys. I have somebody that's dependent on me. If I didn't make it home today,
Mm-hmm.
what would happen to this individual, a spouse or a kid or whatever, a charity or
Mm-hmm.
just getting your home paid off, final expense, whatever it may be. So that individual says, I want to accept that responsibility. So that could be any kind of employee out there. Now, the where I'm kind of leading today with what our topic was today doesn't preclude anyone out there that has the wish to put money away and needs insurance. But what I was talking about is that business owner that
Mm-hmm.
maybe says, hey, I'd like to put something away. I'm just not sure how to do it. I do need insurance. I might have in addition to a spouse or whatever, I might have a partner that
Mm.
I say, hey, if something happens to that partner, how am I going to buy his spouse out and how am I going to take that business over? There could be all kinds of different needs. And so that's another person that might fit into this type of a plan. And then
Mm.
the employee, the upper end higher paid employee might say, "Hey, I'm maxing out my limits on my qualified plans. I'm fortunate enough at the end of the month to have a few extra dollars that I really don't have to spend, and I'd like to find some place to put it rather than just putting it in a bank.
Yeah.
And also, I need life insurance."
Mm.
Here's a great way to do it. It's a wide range of people, and I'll tell you, I've never delivered a death claim check, a life insurance check yet, where the people said I didn't need it or that's more than I really need. They
Yeah.
need it.
Yeah.
It's just how it is.
Yeah. Okay. Is there any situation where a qualified and a non-qualified would work well together?
Yes, very much so. So as we were talking about, I think filling
Okay.
those gaps. So we talked about a required minimum distribution on the qualified side. You don't have that on the non-qualified side.
Mm.
Being able to access your money before 59 and a half without a 10% penalty, qualified. You don't have that on the non-qualified. Self-completing, meaning to me, self-completing means that if I pass away,
Mm.
there's a death benefit.
Mm.
Another thing that some people think of as self-completing is with life insurance, you have a option that's called a waiver of premium. and the waiver of premium, you need to check with the company to make sure that it's exactly what we're talking about here. Kendi can help. Of course, you can help with that. But waiver of premium would mean if I became disabled and wasn't able to make that premium, that premium would be made for me.
Hmm.
So that policy. So just some type of benefits. And then I think the largest one in the group we're talking about is I've maxed out my 401k. I've maxed out my qualified plans. I can't put any more money away. I'm making a lot of money and I want a tax deferred vehicle, a way to put this money away. And so
Okay.
those are ways they go hand in hand and fill the gaps.
Hmm. That's awesome.
Yeah.
Uh, as we've talked about this, it's thank you for explaining it in such a way that makes sense, especially,
Sure.
to business owners and me being one of them. I personally, I have life insurance, I have an IUL, and as a business owner, I've had to use that policy myself, just
Mm,
like you. And I've been really grateful to have access to that.
hmm
Um, this is a question that I do have in regards to taking loans against policies
hmm
because when I took a loan against my policy, there was small interest. So
hmm
when it comes to taking a loan against a policy, can you talk about the interest side as far as repayment goes? Because I've heard that there are certain policies where it's 0% interest, and then
hmm
for mine it was not the case. So can you touch on that?
Sure, sure. So I'm going to say it in this way. If you have your agent say to you, "Hey, buy this policy, you'll get to retirement age and then you can take money out and in the form of a loan and you never have to pay it back and you're going to be set for life." Be careful.
Yeah.
Could that be true? Yes, it could be. But there's a lot of fine print that you need to follow. And
Mm,
you need to have an insurance agent that stays with you
mm,
over the years. I run into more and more people that follow that philosophy I just mentioned, and then they're 65, 75, 85, and they say, geez, I never even took the income and my policy's running out of juice,
mm.
or I should have done this, or I didn't know that. I'm elaborating a little more than you asked me, but I think it's an important topic here. So you have to have a great advisor that can
Yeah.
advise you and to walk you through those. So now let's talk about the good side of that, what you were mentioning, and the interest rate and how that works. Policies earn the life insurance policies we're talking about have the capability of earning um, interest, tax deferred income
Hmm.
or tax deferred money that's inside the policy. When there is a sufficient amount of money in there, that's it's we're able to pay the death benefit and we're able to out of that money that's in there. You get to a point and it's down the road. This is not a savings account. It's down the road,
Hmm.
maybe 15, 25, 30, 40, 50 years down the road. And you get to a point where you could say, hey, I want to start taking money out. I want to start systematically for the next 20 years or
Hmm.
just a loan like you're talking about. And let's be specific to just the loan because that's where you were asking the question. So you take that money out and let's say you have to borrow out $30,000 and you take that money out and the policy, depending on what type it is, again, you have to read that fine print and we'll help you with that,
Hmm.
is still earning money, but you're being charged a certain rate on your loan on the amount, the 30,000 that we just talked about taking money out. So some people say, well, that's a wash loan. And
Yeah.
maybe it is. Maybe it
Hmm.
is where you're saying, hey, I'm earning 5% and the loan is 5%. So it's a
Yeah.
wash.
Yeah.
Okay. And maybe that's the case. And a lot of times it is. But, but you have to just be careful of that. Some policies you actually are taking money out of the policy. Other times you're getting the money out when this is a loan. You're
Hmm.
taking the money out of a general account at the insurance company. And so your policy's still performing as it
Hmm.
was, and you're being charged interest from a different account.
Right.
There's, I don't want to give a specific, here's the answer
Hmm.
because intentionally, because there isn't just an answer to give you.
Yeah.
It all can work, but you just have to have a good advisor how to do it. I don't want to say in your video, this is how it works because
Right.
maybe their policy isn't set up that way. But there are ways to get money out tax favorable. And where there could be a wash loan, you might even be in the situation where people call an arbitrage, where you
Hmm.
say, "Hey, I'm actually making money on my loan." But don't go into it thinking, hey, this is what I'm going to do. I'm going to make loan on this. Our
Right.
bottom line with doing this is to help the clients put money away in a tax favorable basis and to protect their families and their loved ones if something happens. And if it fits, it's a fantastic product. And if it doesn't, we're going to tell you, hey,
Yep. This is not a good option.
yeah.
One of the things that's coming to mind as I've been listening to you is the importance of working with someone
Hmm.
who cares genuinely about their
Hmm.
clientele and who is
Hmm.
not just looking to make a sell and then you never hear from the insurance agent again.
Absolutely.
So can you touch on, just because, with life insurance, there are a lot of intricacies and a lot of different variables that have to be taken into consideration for the client. What would be your advice to people who are looking to work with an agent? What should they be looking for?
In the agent itself.
Yeah.
So one thing that I ask people a lot of times is it could be a first time meeting to them and we're just happen to talk about life insurance. That sounds like a fun time. But one of the things I ask them is I'll say to people is when was the last time you had your policy reviewed?
Mm,
And they'll either say, geez, never,
yeah.
because and that tells you right there, well, the agent isn't with them. Or you'll say, when was the last time that you spoke to your agent even?
Mm,
And they're 9 out of 10. I hate to say this, it's a sore spot in our industry. 9 out of 10 people will say, I don't even know who my agent is. And
oh,
if that's the case, if you're one of those people that are watching this and say, I don't even know who my
mm,
agent is or who to call or whatever, then that's you're the person that needs to call Kendi. And because I
right.
know her personally from working with her for years and years that she cares and she follows up. That's why I'm doing this video with her
Mm,
to help support her in what she does. She does such a fine job. So those are the things. I think more important than anything is to get somebody who's consistent and who will follow through with you. Because in your case, you're very intelligent at what you do here, but if you have questions, you have a resource. You can come to someone like me, and I have a resource where I can go to the insurance companies themselves. But together, I don't
mhm,
know it all, but
yeah.
together we find the answer and we do it. And we help the client. But the number one key there is that you're available to help that client. So if any of you are out there and doesn't have an agent or has policies and hasn't talked to the agent even in 2 or 3 years,
Ugh,
that's what the problem is because the worst thing that can happen is that you'll get 10, 12, 20 years down the road and all of a sudden you'll say, "Hey, I didn't think that's how that was supposed to happen," or "I
yeah.
didn't think this was going to lapse," or what do you mean I don't have this or that?" And
Yeah.
that's a horrible thing to run across.
Yeah, that is. Oh gosh. Dan, thank you so much for that. Is there anything else that's coming to your mind right now, given what we've talked about with qualified and non-qualified plans? I mean, we've covered kind of a lot today, but is
We
there
did.
anything else that you're thinking of would be important to mention before we end this?
Well, as an older person as myself, as I am here, it does make a difference if you put money away along the way. It does make a difference if you've taken care of your family and your loved ones. Those things are important. And I'm very pro insurance. I don't think it matters so much if you do qualified or non-qualified, but do something
Yeah,
one or the other. And if you're not sure, or if you've maxed out your qualified plan, then look at some other options because they complement each other more than they compete with each other.
that's awesome. Dan,
Yeah.
thank you so much. I'll just add to that. Um, I'm not I'm not quite where you're at, but I'm getting there. And
Okay.
it's
I hope that
it's
doesn't just mean old.
it's amazing how quickly life goes by.
Oh yeah.
And when we're younger, there's often that we'll just think, well, I'll do it later when I'm making more, when I'm making more, when I'm making more.
Hmm.
And
Hmm.
if we're not careful, we're gonna get to that point in life where we're there and we're
Hmm.
gonna need to have savings. And so even, especially when you're young, even if it's just a little bit, just to get started,
Hmm.
that little bit can grow. And then as your income increases, you can have conversations to look at the adjustments that can be made.
Absolutely.
Just,
Absolutely.
it's so important to start saving. So,
Absolutely.
Dan, thank you so much for your time today. I
Of
always enjoy
course.
our conversations. I learn
Sure.
so much from you. And just as, as owning my own business, just to reiterate, I don't know everything when it comes to life
Sure.
insurance. I'm still learning a lot, but it's so good to know that I have someone like you that I can turn to who guides and counsels me.
Sure.
And I appreciate you so much. So thank you.
Absolutely. Thank you. Thank you.
Okay.
All right. Let's do another one of these soon.
Oh, we will. Okay. Thank you, Dan.
All right. Thank you. See you later, guys.
Okay. Bye.
Bye.